Hi everyone, welcome back to Village. Happy Sunday. As you're getting ready for the week ahead, we wish you a wonderful week, and it'll probably be the last week of October, second last week of October maybe, because October, November will probably spread on over each other over the week. So keep that in mind. We're rushing towards Halloween and we're rushing towards Thanksgiving for those of you who are in the US who are watching us, and we wish you a wonderful few holidays which are coming around for you. For us Indians, Diwali is here, and we hope you have a wonderful Diwali as we're coming closer and closer to that. With that said, we always look at long term on this channel, and we are value investors, and we always try to talk about value investing and the importance of value investing. One thing which Shashwat does feel disappointed is that we don't do enough videos about purely on value investing, because the reason being value investing is very boring and it doesn't land on the what you call viewership as much as the other videos do. Our editorial team keeps telling us to talk about specific stocks and specific companies which keep making noise. We do cover that because our editorial team keeps telling us to do that. But Sundays are usually reserved for me and Shashwat, or Shashwat and I, to be correct, to do what we wish with it. And thankfully, Shashwat has bought us something wonderful to talk about. It's another memo from Howard Marks. And without wasting any much more of your time, I'll let Shashwat walk us through this one.
Sure. So, this is an interesting memo, and it's something which we have talked about before multiple times, but it's something which we need to keep in mind, especially today when there's a lot of noise circulating around. So, this memo is called Mr. Market Miscalculates, and it's a memo on basically how Mr. Market, that is Benjamin Graham's personification of the market as a person, and he gives this character a few traits. He says that the Mr. Market can either be manic or he can be depressive. So suddenly he may decide to be exuberant and pay anything and everything for anything and everything you have. And in the other hand, Mr. Market can be extremely depressive, and he can say that, look, I can't pay you anything at all, and I'm going to sell my stocks at any low price possible. That is, he's very panicked and he wants to get out as soon as possible. So there are two states through which Mr. Market oscillates, that is, our own markets oscillate. And it's very rare, or rather a very short period of time, that Mr. Market is right in the middle where everything is accurately valued. So when it comes to this, let's see what Howard Marks has to say. So the first thing he says is that when he's over enthusiastic, you can sell to him at prices that are intrinsically too high. And when he's overly fearful, you can buy from him at prices that are fundamentally too low. And he says that his miscalculation provides profit opportunities to investors interested in taking advantage of them. So, in the previous few videos, I think someone had posed the question that maybe we should book profits and then buy back when Mr. Market wants to sell at a lower price. Look, we're not doing cigarette butt investing, especially when you're looking at your long term retirement fund. So if you're looking at your long term retirement fund, you want to follow more of the Warren Buffett, Charlie Munger way, where you just buy good companies which are fairly valued and are great companies, and you buy and hold them, rather than buying fair companies at cheap valuations. You buy fair companies at cheap valuations when you have a lot of time on your hands and you want to be able to play around in the market a little bit to be able to make your return. However, if you're someone with not so much time, I think a commenter had recently posted that if I had just held the Nifty 50 for 5-10 years, I would have made a higher return than any one single company which you guys have talked about. There are no disagreements here. We've never come out and said that indexing was a bad idea. So I don't know where people get the idea that on this channel we don't talk about indexing. That's the first thing we talk about. We love indexing. If you want to go out and buy the Nifty 50, be our guest, because that's something which we believe in. And if you think that that's the path for you, then you should definitely do it. And in fact, we strongly believe that majority of investors would benefit from just buying a portion of the index and sitting tight for a good few decades. That's the bread and butter of investing. So what do you think about that?
I completely agree. Indexing is a fabulous way to generate wealth, and we do not recommend indexing enough, which is true. But if we had to choose between buying stocks and indexing, any day indexing trumps. And even Warren Buffett has said this. There is the famous bet. We have done multiple videos in multiple languages about this famous bet. All of you can Google and read about it further if you want, because I don't think you'll be required to talk about that bet. Rather than a nutshell saying that Warren proved beyond reasonable doubt that there's no way you can beat indexing to any mutual fund there in the market. That said, if this is all true, then why are you telling us to buy stocks? Well, the funny thing is, me and Shashwat are never asking you to buy stocks. Me and Shashwat are asking you to buy businesses. We're asking you to invest in a business. So there's a big difference here. We're not talking about trading. We're not talking about buying something, holding it for 10 years and seeing returns for 10 years. No. We're talking about joining a business. So there's a big shift in mental mind frame if you want to think about it. Because we're not talking, though we say it, that if you hold it for 10 years, we hold it for 15 years, you'll see fabulous returns. Because the reason why I have to say that is because that's what you guys are hearing. If I did not say that you need to hold it for 15 years, you need to hold it for 10 years, you won't be interested in what we're saying. Because when you are investing in a business, your mindset is very different. The relationship that you have with your company is very different than if you're looking at it as a stock. This market mania, which we talk about, where you go from one extreme to the other, you only fall prey to that is when you look at what you're doing as stock buying and stock selling. Because immediately when Shashwat says what Howard Marks said about Mr.Market, you can sell things which are very expensive to him and he'll buy it. And you can buy things very cheap from him because he's selling it to you. That can only happen if you have this notion of buying stocks and selling stocks all the time. That's when you think of cigarette butt investing, where you're like, I buy low and I sell high. We're not doing that. So you got to look at it very differently. Like Warren Buffett, he buys American Express. He holds it. He's never talked about selling it. He bought Apple.
There's an important point there also that if you want to buy and sell, then you have, yes, Mr. Market does go from very happy or exuberant to very depressed. But the point of this is that you can't predict when he's going to be very happy and when he's going to be very depressed. What if your next point of him being very depressed is 10 years away? I mean, it's possible. We haven't had a recession. I mean, yes, the COVID crash was one, but we haven't had a prolonged recession in a long time. I mean, if you talk about any sort of crash, we haven't had much time to dip into the crash and buy. So, what if the
And
next
even
time,
these crashes don't last very long.
yeah,
A lot of you think, the market crashes will be crashed for some time and again. No, they don't. That crash can just be, some famous flash crashes. Some crashes just last a few days to a few months. Very rare does it be that it lasts a year or two. Those are very rare indeed. So if you're thinking, I'm going to wait till the market is going to crash and buy, for 3-4 years, that's not going to happen. And those are very rare, maybe once in your lifetime. And let's say it just happened when you were a child. Maybe the next one will happen when you're 60 years old, 70 years old. And what? For the entire lifespan, you're going to be sitting and waiting? I don't know. That doesn't make any sense to me.
yeah. So that's another point. And when we look at again what Howard Marks says, he says that there are several factors which contribute to how in the real world any news that goes from ranging from pretty good to not so hot can be perceived as flawless to hopeless, like in the sense that the pendulum in the market swings from end to end, whereas news in the real world only ever swings from good to maybe not so good. So you have a very minor shift in the real world, and the resulting swing in the market perception goes from end to end. And this we can see in very recent developments in companies which we've discussed on this channel, and other scenarios like even China, for example. Things aren't suddenly, China's problems have not vanished away. But why did the Chinese index go up by 20%? Simply because that relative to where China was, it seemed like things went from hopeless to very hopeful, and a lot of investors felt like suddenly that a defibrillator machine was used upon them and they were brought back to life. So the point here is that even a bad scenario can be interpreted as a good one depending on how the market was feeling before. And it's very hard for people to predict this and estimate this, which is why we have something known as the intrinsic value method and margin of safety. The margin of safety is, yes, one, to make sure that your calculations are right, but also two, the margin of safety is also important because you never can predict how the market swings and how the market swings can affect the company which you're purchasing. There could be a long period of time before your bet gets realized, which means that you could be sitting on no returns for a very long time. This has happened not only to the average investors like us, but also to very good investors. There have been multiple value investors who have given out interviews saying that, I was at the right place but at the wrong time, in the sense that I should have taken on the bet much later because I took it on too early and I lost a lot of money on while waiting for my bet to come to fruition. So
No,
you
that's
have
very
to
true.
understand. Yeah, sorry, go on.
Yeah, like say you take Tata Steel for example. If I had bought Tata Steel at 2016, 2015, and if I had bought, let's say, even Manappuram at the same time, I will see great returns in something like a Manappuram. While Tata Steel hasn't really gone anywhere in the last so many years. And Tata Steel is a great company. It really does matter when you're buying it. And but one thing you should keep in mind is, if you notice, we're always talking about when you acquire a stock, right? Intrinsic value when you acquire a stock. Everything is about acquiring a company. Never do we ever say that you should be selling it. And that is something very important fundamentally to remember. So when we're always talking about how to acquire more, when you should acquire more, when you should be buying more. But never do we say like, okay, you did your intrinsic value calculation and now it's cheap and you bought it at value. You don't keep doing intrinsic value calculations every year or two and say, okay, now it's become very expensive, so I should get rid of it.
Yeah.
And the
And
main reason why you should not do that is because you can't keep trading it like this, right? Someone like Warren Buffett can think of it. Someone like, Howard Marks can think of it, because they're like, a huge grocery store. They're like a market themselves. The size of their portfolio is so huge. They're like a Mr.Market themselves. They can decide to move in a certain direction. We are very small. Once you've created a portfolio of X amount, Y amount, then you can think about all these things. But that's something I want you to remember. Every time when we do talk about these things, we're always talking about when to enter, when to enter. We never talk about when to exit. So because the reason one need to exit is if there's something fundamentally wrong with the business which you have invested in. Something is wrong with the owner. Something is wrong with the industry. It's a dying industry. Like film cameras, like Kodak. So, if you're thinking about that, then it's a time to exit. But other than that, we never keep talking about exiting based on some equation or some calculation, if you notice. That's what I wanted to add it in.
yeah, and to quote Howard Marks, he says, "My bottom line is that markets don't assess intrinsic value from day to day, and certainly they don't do a good job during crisis. Thus, market price movements don't say much about fundamentals. Even in the best of times, when investors are driven by fundamentals rather than psychology, markets show what the participants think value is rather than what value really is. Value is something that market doesn't know anymore than the average investor. And advice from the average investor obviously can't help you be an above average investor." And I think, in a very facetious way, he says something which is very important, that if you keep taking the market as your indicator of whether your investment is a good investment or not in the short run, then you won't have a fundamental answer which satisfies you, because one day the market will tell you that you've done a brilliant, wonderful job at picking this company, and the very next day it'll dump everything on you and say that what an idiot, why would you go into this company, I'm exiting. And then if you follow the whims and fancies of the market, you're definitely going to find yourself neither here nor there. And he makes a very important point, which I think everyone at home, if you haven't paid attention for the rest of the video, I hope you pay attention for this part. He says that, as my partner John Frank points out, in comparison to the total number who own each company, it takes relatively few people to drive up prices during bubbles or down during crashes. When shares in a company that was worth $10 billion dollars a month ago trades at a price implying a valuation of $12 billion dollars or $8 billion dollars, it doesn't mean the whole company would change hands at these prices, just a tiny sliver. Regardless, a few emotional investors can move prices much more than should be the case. What do you have to say about this part?
I agree. It's very true what he's saying. And this case is a proof and point of what happened in Manappuram prices also. Fundamentally, nothing has happened. Other than that, they've done some malpractice in a certain division, and they have already come out in full strength. The board had an emergency meeting and they've come out and said, we agree with everything what RBI has said. We will follow it, we'll implement it, and we'll report back as soon as possible. There's no argument here like that, they've said. But Mr. Market decides to move one way or the other for whatever motivations they have. And it's true. And what to add is, dieting would be a great example for that, because a lot of you think dieting, you do something to get to a certain weight goal. And that's where diet fails. Because when you stop dieting, you immediately put back the weight. If you look at investing like that, yes, you will invest for a while, you will make some returns, you will see some gains. Then you think, okay, I've achieved it. And before you know it, you'll be back to where you were. So that's why in dieting, weight loss, we say it's a lifestyle. You have to choose a new lifestyle. Value investing is wealth creation, is a lifestyle. So if you want to do value investing, you have to embrace it in entirety. And you have to think of it as a change in your mindset, and it's a change in your lifestyle. And that's when that kind of wealth creation happens. If you look at value investing as a method to make some quick money or to take you to a retirement fund, it will do that, maybe, I don't know. But it's not going to be what you really want. Because on that road, somewhere along the line, most people will stop following it, and then they'll be back to where they were. And they'll blame value investing for it. And that's not the case. Because if you follow what Howard Marks is saying, and you believe in it fundamentally, and you keep inching, yourself little by little every day, and you take it as a lifestyle, and you don't have an end goal other than doing this on a disciplined, systematic way, results will happen. Because you don't worry about the results. But that takes a very different mindset. And I don't know how many of you really truly are like that, because you tell this to trader all the time, saying that, I'm like Anand, I just want to buy and hold forever. Then in the market shakes a little bit, immediately you panic and you're asking trader, should you sell your positions? You see a video, me and Shashwat talk about something critically, immediately you reach out saying, please tell us, should we buy or not buy? And that is the case in point, which Howard Marks is saying and his partner is saying.
Yeah, and to that point, he ties it all together and he says, in other words, it's the primary job of the investor to take note when prices stray away from intrinsic value and figure out how to act in response. Emotion? No. Analysis? Yes. So that basically ties it all together where he says that, look, your analysis should be based solely on the fundamentals of a company and its intrinsic value. Tomorrow, the market may decide to tank your stock by 70%. It's going to be a small group of people trading hands with each other, and they're going to value it 70%. But that information is now leaking out to you, and now you are panicked and you think that you have made a mistake in your analysis. It may well be that you might have missed something in your analysis. You can go back to the drawing board and rework your analysis and make sure check all the points that you need to check. And if the analysis still returns out positive, then I don't think you don't need to be as worried as you are, because at the end of the day, fundamentals are what matters. Sooner or later, the market will realize its mistakes and it will come back to where it should be at. So this reminds me of an Eric Clapton song with his band Cream, where he says, I'm so glad. So when stocks, that is Mr. Market, decides to tank a stock which you've been purchasing, and decides to give you a 15%, 20% discount, most of us would rush to Flipkart or Amazon and buy that product if there was a 20% discount on a product we've been
Why?
looking for.
iPhone, same thing.
Yeah, iPhone. If big billion day offer or whatever they call it these days, but yeah, big billion day sale, you'd go there and you'd immediately see a 30% discount and you'll hit buy, and maybe you'll feel so generous to even buy your spouse one, or you might feel so generous to buy your parents one. But when it comes to stocks, the narrative is different, where you get a company which is selling at 30% lesser than what you already bought it at. Yes, there is the natural fear that, oh my god, did I make a mistake in my valuation? But then you go to the drawing board, you see nothing has gone wrong in your analysis, and then you have to play a nice song to yourself and say that, yes, it's my time to get a stock which I've been buying previously at a premium, at a discount. and make some money as a value investor. This is in relation to no stock, which we've discussed. This is only merely general takeaways from Howard Marks's memo.
The article Shashwat is referring to, my editing team will put a link to it down below, and I cannot strongly recommend it enough that you guys read it and digest it. It'll be lovely if you do digest it and then put some comments on what you read. That'll be wonderful. Then Shashwat will feel vindicated that some of you actually read and follow the stuff he's saying, and we will definitely do a Q&A with Shashwat on some of the comments you guys have managed to think of after reading that memo. That being said, we do hope you have a wonderful week ahead, and do take care and be safe out there. And me and Shashwat will join you again in another video soon. Thank you.
Thank you. Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles VinodSrinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.